How many times have we talked about Europe and misplaced hope? Is it different this time?
Good morning, Jonathan. No, I don't think it's different this time, and the issue is the same, and it's one that I think, frankly, is starting to plague the U.S. markets as well, and that's simply that European investors, and now increasingly U.S. investors as well, are locked in this sort of collective hallucination with the central banks around valuations and what they mean, and the fact that there's a lack of desire to acknowledge the fact that market valuations are entirely, frankly, fabricated or synthetically generated by all the central bank liquidity and do not reflect fundamentals of the securities that they represent. And that's a general issue. In terms of the virus and its progression, we're seeing, obviously, call it a second wave or whatever you like in Spain and other parts of the world. So clearly and certainly in the U.S., of course, and we're certainly not out of the woods there. So I think generally central banks continue to run the show, and investors need to be really, really cautious here.
How cautious should they be? We've had many, many conversations about migrating down in credit quality with the cover of the Federal Reserve, the ECB, and others as well. Oksana, have you not been doing that?
No, absolutely not. There was a time to be migrating down, and if you recall, we spoke in March, and things were looking obviously significantly worse in terms of the forecast, but they look significantly more attractive in terms of valuations, and we did get involved at that point. But currently, when you think about the fact that fallen angels are at record levels, and we're not seeing that reflected in valuations again because of the Fed simply trumping the bid. I think this is the time to really raise some liquidity and think about the fact that we're going into a much more difficult second half, most likely. We have a number of fiscal cliffs that are upon us in the next few weeks, right? The $600 federal fiscal relief program, $600 a week. The eviction moratorium is up, and a number of other programs, and Congress is headed for recess in early August. So we have a lot of things that have been supporting this market that are dropping off. We continue to hear the steady drumbeat of downgrades and defaults. And frankly, even if we have a vaccine arrive on the scene somewhere by the end of this year or early next year, which are some of the most aggressive reports, we will still realize that the damage has been done. A business, particularly a small business that's been without revenue for months, is not going to be able, and was forced to close, is not going to be able to reopen simply because the vaccine is here now. So I think the news will continue to feel, on the ground pretty dire, and investors have done really well here, and this is a time to raise at least some liquidity.
What would you be doing then, Oksana? Because you're making the point that the 90% economy is not good enough. Everybody would agree with you. But many other people think that policy can offset that fact. You're saying essentially that it can't. What should people do?
So I think first of all, raising some liquidity here makes sense. Staying high quality makes sense. There are parts of the market that are not getting the love that the market generally in credit is getting. We've seen obviously tremendous inflows into the credit markets generally. Specifically, the Fed is holding something like $12 billion across credit ETFs, which is very significant. But you have the areas of the market like floating rate investment grade debt, for example, that has seen no issuance and that has seen really very little support, but of course has benefited by association. But given that that's not an area that is experiencing a tremendous amount of issuance, I can see how that eventually becomes an area where there's a shortage of supply and prices can eventually reflect that. But generally, I would err on the side of staying high quality and very liquid. And by high quality, by the way, I do not mean extending your duration profile because, of course, de-risking in prior periods, in prior cycles, has meant going longer duration, and that's probably not the prudent thing to do here. Over the next couple of years, we may see even a small rise in yields have dramatic impact on traditional fixed income portfolios because, remember, what can really shut down this whole central bank party is potentially the reemergence of inflation expectations. Not even necessarily inflation itself, but if the market decides all of a sudden that, inflation is not something that we should entirely discard, that's what effectively shuts down the central bank party. And that's not a risk that investors should completely dismiss. And I think ultimately fundamentals will prevail. And so when you ask what should investors do, they should look to the things that make sense fundamentally before investing.
Well, Oksana, reconcile these two things for me. How can we have a 90% economy, far below capacity potential, and also have inflationary risks?
So that's obviously a huge question, and it's certainly not, when I talk about inflation, it's certainly absolutely not a near-term risk. It is not a 2020 risk, and it's likely not even a 2021, first half of 2021 risk. But it is something that we may see come back into the headlines perhaps later next year. If you look, by the way, at inflation expectations, they're starting to diverge from the actual inflation numbers, right? We're seeing an uptick in inflation expectations. And so that's an interesting diversion that people should be paying attention to. And so in the event that we are plateauing at a 90% or wherever it is we're going to plateau, and I think we're starting to see that level, right? We're starting to see that process of plateauing. We had initially a strong bounce off a very, very bad bottom, and now we're seeing the process of the economy plateauing. No, in that case, inflation is not a near-term risk at all. But ultimately, for portfolio construction that looks beyond the next 6 months or even 8 months or 10 months, I think that's something we cannot absolutely discount.
Oksana, just to wrap things up, you've brought up the point for a 10-year Treasury, and most people would say we've seen a huge move lower in 10-year yields through this year so far in 2020, but at 60 basis points. You're saying that effectively, because we didn't collapse to zero, there's a message there somewhere. What is that message, Oksana?
That's a really important point that you bring up, Jonathan. Absolutely. I think given the enormous amount of stimulus, the enormous amount of money that has gone into the Treasury market, both from the Fed and investors, the fact that we didn't collapse to zero is actually telegraphing to me that there is potentially, a coiled spring effect there, that, we didn't really see 10-year Treasury collapse to zero as perhaps we would have expected under the conditions of a severe recession, a lot of government intervention, and tremendous appetite for de-risking, right? And even under those conditions, we didn't see it collapse to zero, and that tells me that the market is telegraphing something that investors perhaps do not want to recognize, which is that we may be going somewhat higher pretty fast as things do start to either normalize or the debt effect really starts to settle for both international and U.S. investors. And by the way, international demand for U.S. credit is at an all-time low. So it's not necessarily even connected to a strong recovery, but more really to the fact that even a 10, 20, 30 basis point move from here has really dramatic consequences for portfolios.